Hey everyone. Hope everyone had a good day and is doing well. Let me just check the microphone setting, make sure it's working. Looks like it is. So let's start with the daily chart. And on the daily chart, I need to update this, but I'll make a note and update it later. Anyways, so what's going on the daily chart? If you listen to the review yesterday where I talked about last Friday, I mentioned, I mentioned that the Bears had a second entry short. We rallied. Let me fix one thing. One moment. There we go. Anyways, I mentioned on that Friday formed a second entry short, and it broke strongly below last Thursday right here. So the Bears, they had a strong bear breakout, and Friday was a big enough bar that I thought it increased the odds of at least a little bit lower. Now, the one thing I thought coming into today, I did not think today would be another strong bear trend bar, which meant today was either going to be a weak bear trend bar or more likely a bull trend bar. And no surprise, big bear bar, bad follow through. For the bulls, it's a double bottom, but who wants to buy above this bull bar? It's a pretty weak bull bar. Therefore, if you're a bull, a lot of bulls would rather wait for consecutive bull bars, two or three strong bull bars. More likely, we're in a trading range and the market's deciding, are the bulls going to get an upside breakout and test of the September the 1st highs, or are the bears going to get a second leg down? Sell off, two-legged pullback, bear breakout, but we still have to break below. So when I look at this, I see a trading range. I see a tight trading range within a larger trading range here, within an even larger trading range here. So if we just take a look, for example, let's look at here's the past. So here's June the 8th of 2023. And what is that? 4 months plus, a little more than 4 months. That increases the odds that the market is going to go and continue to go more sideways. So I think we're pretty neutral. I want to check and see when the next FOMC report is. So the next FOMC report is actually this Wednesday. So this week is an FOMC week, and it's possible that we go sideways up until the report and get as neutral as possible. You can see we formed an inside bar last week. The Bears, they see this as the low one, kind of a double top. We rallied. Let me make this a little bit bigger. We sold off and then we rallied here, sold off, tried to rally again last week. And by the way, on the blog, I made a mistake. I meant to, and I forgot to correct it. I'll correct it after this. But anyways, on Friday of last week, I mentioned that the high of Monday was going to be resistance, or the high of the beginning of the week. What I meant to say is the high of last Monday, which would technically be Tuesday, the start of this bar was going to be resistance. In other words, if you go back to Friday's blog, what I meant to say was, we were obviously somewhere down here. Let me back up. Let me go to the daily chart and explain it, because that'll make more sense. Even though obviously we had a really big day Friday. But anyways, what I was trying to say going into Friday, which is basically the close of this bar, This right here is last Tuesday, so 2 Tuesdays ago, and I mentioned that the high of this bar was probably going to be resistance. So my thought was on the open of Friday last week, I thought that we would have a hard time getting above here. I didn't expect this to happen, but my thought was at least the high of last Tuesday, which is the high of the weekly chart right here. I thought that would be resistance, and you can see we came really close to it on Thursday and sold off. But so far, going into this week, it's a triangle, tight trading range. There's probably buyers below last week. But in general, whenever you get a bear bar closing on its low, you have to respect it. We don't know how many bears are willing to sell here. And the bulls want a strong buy signal. But if they fail to get it and it's a weak buy signal bar, so for example, if this week closed right now as a bar like this, you might have traders selling the close, betting on a second leg. So it would not take much to get down here. And I do think we will get down to the close of this bar. We had a strong enough bear breakout, pullback. We'll probably test back down here at some point fairly soon. 5 minute chart, we have we had bar one, which was a pretty decent bull bar. Strong bull bar. And the one thing I thought coming into today was yesterday's low, which was last Friday's low, the low of this bar, was probably going to be resistance. We broke below it on the open, and you can see we rallied on the high of bar one. What about buying above bar one, betting that it's a strong enough buy that will probably have at least a second leg up? Some traders will, and it's an okay swing buy. My only problem with it is risk reward. Very big bar, tail on the top of one. It's not, let's see how big the tail is. Open of the bar, well, the close of the bar, 8.5, and the high of the bar, 9.5. So it's a 1 point tail, and that's a warning that traders sold into the close of the bar. For me, I think this bar is a little bit too big, but it's an okay swing buy. Whenever I'm buying above a bar like the open, whenever I'm buying the close of bar one with the stop entry, I'm typically more willing to buy the on a stop above the bar rather than the close. So why not buy the close of bar one? Because it happens often enough where the open of bar two immediately sells off, trapping those bulls and trapping the bulls who buy 50%. And you can see, look what happened on two. Two, we broke above one and we rallied, but a lot of the bulls that bought above one scalped out. For the bears, they'll see it as a breakout pullback short. But for me, I think one is damaging for the bear case. One's a big enough bar that we're probably going to have a trading range day and not a bear trend day. And when you include the context of the daily chart, I thought the odds were even higher now with bar one being a bull bar that today is not going to be a strong bear trend. Some traders who bought above one, disappointed with two, they will look to get out break even after the close of bar two. Bar three, bear breakout, broke below two, trapping the bulls who bought below two. But a lot of those bulls, if they're buying below two, probably were willing to buy more below one. So some bulls, they buy the two low or they buy the one close, they buy more below one. A lot of those bulls would get out break even around the midpoint. Other bulls would hold long, betting that we would get back to the one close. And I'll take that trade sometimes. Buy the close of one, buy more below one, or maybe buy the close of one, buy a 50% pullback, then might buy more below one. And the only challenge with taking that trade is the risk is always bigger than perhaps what you want it to be. And it can be a little bit scary. You're buying, and maybe you're buying more down here. And your stop realistically is probably somewhere down here. And if the bears get a strong bear bar and another bear bar closing on its low, a lot of those bulls will exit and then re-enter above a bull bar if the context makes sense. Four, follow through for the bears. but failed to close below 3 and failed to close below 1. To me, this looks like a trading range open, and we're still in this broad bear channel. So you can say bear channel, these highs and these lows. For me, I like to think of bear channels as kind of what Al says. He likes to draw trend lines with a thick crown or a fat crown. And the point behind that is the line is a zone, it's not exact. And then you can see bar 5, 5 broke above 4 and tested near the 2 low and the 1 close, but it's a bad stop entry above 4, and that will reduce the number of bulls buying above 4. To me, this looks like a limit order market. 6, testing near the 4 close and the open of bar 5. Low 1 short below 6, probably buyers below. What about buying above 6? Some traders might, but for me, not yet high probability. And then 7, we have a doji. So some bulls, if they bought above 6, disappointed with 7, they may scalp out on 8. And you can see we went below 7 and then turned up, closing on its high. For me, 7 is a bad low 1. And because it's a bad low 1, you'll have bulls buying below. Look what happened on the 4 close. You had some traders on the 4 who sold the close of bar 4 at 91.75. And you can see the low of bar 6, 91.75. Then we had bar 8 break below, or let me back up. Bar 8 went below the 4 close and reversed up strongly. So that's a sign of a lot of buying. As strong as bar 8 is, forcing traders to buy high in a tight trading range, but the context is okay. Probably buyers. So for always in traders, if you didn't buy above 6, I think it's reasonable to buy above 8, but it's important to be mindful. You will have bulls looking to take profits back at the 1 high. So bulls, okay to buy above 8, but big bar, big risk. And you can see, look what happened on 9. 9, there were so many bulls or sellers up here, bulls who bought above 8. So they bought on a stop at 8.25. And look what happened. The market went up about, let's say, 3 points, allowing those bulls to scalp out. But if the market, but the point I'm making is a lot of bulls who bought above 8 scalped out above 9. And how do we know that? Because 9 is a doji, which implies that as the bar went up, at some point traders started selling into the bar, which caused it to pull back. And if the bulls were really all that strong, 9 would be a strong bull buy signal bar. And one of the reasons it's not, excuse me, one of the reasons it's not a strong buy signal bar above 8, one of the reasons why 9 is not a strong entry bar after a bar like 8 is because 8's a big bar, and big bars typically attract profit taking, and it will attract more traders selling above the bar. They may not sell the 8 high, but they might be willing to sell above a big bar like 3. So have limit orders to sell right here or at the highs. As far as selling below 9, most traders would not, so it's still probably better to be long than flat. 10, inside bar, breakout pullback buy, but a tail above the bar, probably sellers above scaling in higher, but you're getting a lot of bull bars. Bars 5 through 10, so 5 consecutive bull bars, and that means that bears have been unable to get a bear close, and that's a sign of weakness. And overall context, I think the bulls are going to try and form an early low of the day. 11, another bull bar, but we failed to close above the high of 9 and above the high of 10, and that lowers the probability for the bulls. 12 closed at the, let me see if it closed at the 11 low. The low of 11, 98 even, closed this bar 98 even. So 12 closed at the 11 low and not far below it. What about selling below 12? For me, I would not sell below 12, but I think it's okay to exit longs below 12. The reality is it's probably going to be a minor reversal at best. Low probability Low probability that 13 breaks far below 12. And you can see 14, there were so many bulls, you had so many traders buying the low of 12, bulls trying to get long at a discounted price, and bears, let me back up. 12, the low of 12, you had a lot of traders buying. Some of those traders are trying to prevent the bar 12 signal bar, the bear bar, from triggering because they know that some traders have stops one tick below 12 and they will buy back shorts. Excuse me, they will sell out of longs below the 12 low. And then you can see bar 14 outside down. It's kind of funny with these kind of with these kind of days. It's more of a challenge to there's a lot of information here. And whenever you're in a limit order market, it's always more challenging to talk about the back and forth because there's so much back and forth. And there's a reason I want to bring that up. Right here, it's pretty simple. You have a bear trend from the open, and it's probably going to form a trading range. But then something important happened here. We broke to the downside, but there's a downside bias here, downside bias here. There's a lot of back and forth, and that will increase the probability of a lot of sideways trading. So it's confusing. But anyways, back to bar 13. It's a bull bar. It's a bad stop entry buy. It's a bad stop entry sell. And that will increase the odds that we go more sideways. Bar 15, outside down, large doji bar. Probably buyers below 15, probably sellers above 15. For the bears, what do? I think it's better to be, I think this is more of a limit order market and not a great stop order market. Big bar on 14, but probably going to go more sideways here. And then 15, we broke below 14 and reversed up. For the bulls, they'll see 15 as a second entry buy and an okay swing buy. And the bears, they hope that 15 leads to a failed stop entry and a break below yesterday's low, the blue line. We'll get rid of some of these lines here. 16, weak follow through bar or entry bar above 15. For the bulls, they'll see it as a bad stop entry sell below 16 and therefore buyers below. And then you can see we have a doji on 17, but 17 is a bad stop entry buy above the bar. So there's probably more sellers above 17 than buyers. What about selling above 17? You can. But the one issue is you're selling right in the middle of a tight trading range, and that will lower the probability for doing anything. It's basically breakout mode, middle of a trading range is tight, increases the risk of an upside or downside breakout. The one thing the bulls have going for them is they have a strong layer of support, this blue line, which is yesterday's low, which was last Friday's low. 18, a little bit of a surprise. Some bulls that sold above 17 or 16 probably disappointed by 18 and will try and exit at the original entry, the 17 high. So the bears that sold above 17, they probably scaled in more higher, like above 14. They will try and exit right at the 17 high. And you can see that's what happened on 19. 19, inside bar, bad stop entry sell, bad stop entry buy above the bar, probably going to go more sideways. And then we have a bear bar on 20. Bear bar closing on its low, second entry short, but still middle of a tight trading range. Really better to do nothing here. I think it's okay for bulls. Had I bought above 15, I'd probably get out below 20 if I was still in the trade. 21, weak entry bar, and then it's a doji. For the bears, it's a bad high one, so they hope that there's sellers above 21. And for the bulls, they'll see 21 as a bad entry bar for the bears that sold below 20. And what do you notice so far about the first set the past 17 bars. Every bear bar, really, actually, what do you notice about the entire day? Every bear bar has failed to yield an appropriate scalp. So if you sold below 3, you did not make money. If you sold below 12, you did not make money. If you sold below 14, you did not make money. If you sold below 20, you have yet to make money. And that's all a warning that something is not quite right here for the bears. 22, a little bit of a surprise. Bull breakout, trapping the bears that sold above 21. Increases the odds that will go higher, but the bulls really need follow through. Minimum follow through, bull bar closing above a lot of bars to the left. For the bulls, they'll see it as a bull breakout above a tight trading range, and they hope that we get a strong upside breakout and possibly a test up to the 19 low and maybe up to the 42 low all the way up here. 24, another follow through bar, but look at the bars. Overlap, a decent amount of overlap with 22 after when 23 closed. And look at 24. 24 overlapped about half of 23, and that's a sign of confusion. It's still good for the bulls, but where are the open gaps? You can see the 24 low went up below the 22 high, so it filled the gap. It'd be better for the bulls if 22 is a big bull bar, and then 23 is another really big bull bar, kind of like here. Big bear bar, 43, follow through on 44. But look at the overlap. The overlap was basically 1 or 2 ticks. The market went 1 or 2 ticks above this close and then turned down. Look at the overlap here. The market went a couple of ticks up and sold off, but it's a big bar. So the overlap of 45 relative to 44 is still pretty small. That's a sign of strong selling. Here, it's a bull breakout, but it looks more like a weak breakout. As far as what do? Do you sell the close of 24? For me, I would not. I think it's better to be long than flat. We're always in long, better to be long or looking to buy, betting on a second leg. But we have a cluster of resistance, the high of 51, high of 52, the low of Friday's 19, bar 19 on Friday, the low of that bar, and all of these closes. And then you can see 25, big bull bar, but it's a climactic bar. We have a big bar, 22, smaller bars, 23, 24, and then another big bar, 25. What about buying the close at 25? You can, but it's got a pretty big tail above the bar, and it's a possible second leg trap. We had a rally, maybe up to 18 or 14, complex pullback, second leg, and that will increase the risk that we go more sideways. You can also see it as kind of like a bull breakout of a bull channel. And that's why a lot of times you see it in the video course. If you go to a trading range, I think it's the first video, how to trade a trading range. He shows an example of a channel that gets a late bull breakout. And because of that, the late bull breakout is basically a vacuum test of the top of a channel. And that's why we go a little bit above it, but then we start to stall and we test the bottom of the channel. So whenever you see a rally that looks like this and the start of the rally was maybe the 4 low or the 8 low, this has been going on for a lot of bars. And because of that, the bulls who bought above 15, the bulls that bought above 8 and stayed long, they'll see 24 and 25 as a gift and they'll start taking profits. So 25, climactic bar. Climaxes typically lead to 1 to 4 bars of sideways trading. 26, a inside bar. High 1 buy, might be more sellers above. But as far as selling below 26, I need to see more selling pressure. 27, second leg up after the rally up to 25. No surprise, but bad follow through 26, and 27 is a climactic bar. Look at the tail. There's no tail below the bar. And that means there were so many traders buying this bad high 1, betting on a second leg, that we went up instantly. And because of that, this more likely is a vacuum test of somewhere in here. 28 inside bar for the bears. You can argue it's a second entry short. And because of that, it's a second entry short, but it's a micro channel since 21. That lowers the probability of selling below 28. Probably buyers below 28 scaling in lower. Some of the bears who sold above 26, even though they're selling in a micro channel and they're selling a high one, they know that the odds are, even if we break out and test 45.12, 45.14, maybe not 45.14, but the point is, even if we break out on the next bar or two, we're probably going to test back to the high of 26 at some point soon. And then you can see 28.9, we broke to the upside. And before I forget, I want to say one thing about this. What do you notice about this rally? The rally is not that strong. You're getting a lot of overlap, but it's in the form of a micro channel. So you can argue it's a strong breakout. But the point I'm making is this: it's really difficult for traders. Traders want to buy a pullback. They see these buy climaxes like 25 and they want to buy below bars, but the market's not letting them enter below bars. So what happens is this: 21, 31. That's a 10 bar bull micro channel. It's really, really common for micro channels to occur in trading ranges. And because of that, it's buy climaxes. And by the time you get the first pullback, it typically does not lead to a second leg up and leads to reversal. So what do I mean by that? Let's find an example. Saying this is really important to understand. Strong breakouts, here's kind of an example. This is a strong rally, but it's a micro channel lasting a whole lot of bars. Bar 11, 21, that's an 11 bar bull micro channel. It makes it more dangerous to buy the low of 21. A lot of traders instead will buy a more complex pullback. Here, strong bull bars. Why did traders buy the low of this micro channel? Because these bars are really big and they're reversing up pretty strong, and there's lots of open gaps, and there's uniformity to the bars. Even though it's not great here and here, they're at least strong bull bars. So back to here, this rally could be stronger. Bear bar on 30, starting to get overlap, probably sellers above scaling and higher. We have resistance, the 42 low, 37 low, and the close of this bar. So I suspect we'll probably go sideways soon. 31 inside bar, but probably more sellers above. This is starting to lose the momentum. And if it starts to lose momentum, you'll have more traders wanting to buy at the moving average rather than far above it. And you can see what's happened. We went too far, too fast. Look at the relative slope of the moving average compared to the trend. It's actually really poor. But you get the point. Pretty tight. Look at the moving average. That creates, whenever you can draw a triangle, it's not really a great shape, but it's kind of a triangle. The point with that is that's a warning. Whenever, let me just draw it real quick and finish the. I wish there's a better way to draw with this, but anyways, what I'm getting at is this: whenever you can do this, whenever this area right here gets wider, that's a sign that the market is becoming more and more climactic. So here's the moving average. Here's price going down rather quickly. Once again, really hard to draw with this. You can see this area is getting pretty far. And whenever this gets too big, a lot of traders start taking profits. So in strong trends, you really want price to gradually go up. That's sustainable. The shift key works for TradeStation, but that's not a TradeStation application. Anyways, 32, surprise bar. It's a big enough bar. We may get a small second leg, closing below several bars. probably going to test the moving average fairly soon. And then look at 33, weak, follow through. It's a strong enough bear bar, 32, 33. There might be sellers above 33, but it's still a tight bull channel from the 21 low to the 30 high, and that will probably limit the downside. The bulls, you had bulls buying all the way up, and those bulls are probably willing to scale in lower. So that means we're probably going to go more sideways. 34, surprise, probably at least a small second leg up. Big bar, big risk. And then look what happened on 35. We have a weak doji, probably sellers above 35, sellers above 30, and more sideways trading. 36, bull bar, second leg up after 34, but a bad stop entry sell below 36. And then 37, surprise bull bar. For the bulls, for the bears, they see it as a wedge. Rally on 34, pause on 35, rally on 36, pause on 36, rally on 37, and then a pullback. So if 38 is a bear bar, you may have bulls begin to sell out of longs. Overall, we're probably forming a trading range. We have all this resistance over here, and because of that, the market's probably going to go more sideways. 38 inside bar, probably buyers below, scaling in lower, but it's a bear bar closing on its low. I think it's a better area to take profits because we're probably going to test the moving average and this small gap, 33 high, 35 low. 39 bear bar closing on its low, consecutive bear bars, strong enough bear bar that it's reasonable for always in bulls if they did not get out below 38 to get out below 39. 40 strong bull bar, but a high one buy. For the bulls, they'll see it as a pullback from the rally up to 37, and they want to break out above 37 and a measure move up. The bears, they see bar 40 as a retest of the 37 close. And because of that, they know that some bulls who bought the 37 close will be disappointed with 38, 39, and they'll use 40 to sell out of longs. And because of that, bears will sell the close of 40 as well. 41, you can see it failed to trigger the buy above 40. That's a sign of strong selling. You had so many traders selling the close of 40, and some of those traders may have to stop one tick above 40, two ticks above 40, trying to prevent it from triggering. What about selling below 40 or 41? You will have some bears selling below 40 and 41, hoping that the bulls give up. And if we start to go sideways, more and more of those traders will get out. 42 followed through, but failed to close below the moving average. We've been above the moving average really since bar 14. So that's a sign of pretty strong buying. 43, we tested near the midpoint of 40 and 41. Bad signal bar to buy above 42 increases the odds that we'll go more sideways. 44, bear breakout, but let's see the follow through. It's the first close below the moving average, probably buyers below, scaling in lower. But the one problem here for the bulls is we have obvious targets below. And this whole area in here, let me turn off snap mode. This whole area is a trading range. And because of that, you had bears selling, scaling in higher. And they know the odds are we're going to test back to this area and allow the bears who sold above 21, above 18, above 81 yesterday, above 14 today, and scaled in higher to make money. 45, bad follow through for the bears that sold below 44. Some bears will exit one or two ticks above 45, but 45 is a weak bull bar, so it's a weak stop entry buy above the bar, and that's why we went straight down on 46. The only problem here, you have a bear breakout on 44, bad follow through 45, and another bear breakout 46. So 46 is the second leg down from the 44 bear breakout, and because it's a second leg down, a lot of traders, when they see a bar like 45, if they sold for whatever reason during 44 and they see bad follow through on 45, they know that 46 is a bear breakout and they suspect it will have bad follow through as well. And that's why 47 looks the way it does. 47, strong enough bar, may get a small second leg up. You can argue parabolic wedge, 42, 45, 46. And because of that, there's probably buyers below 48. And then we had a second leg up on 49. But remember what I said over here with 44? 47 is a bull bar, which means 48 is a pause. It's bad follow through for the bulls that bought above 47. And now 49 is a strong bull bar. So what do you think 50 is going to be? Chances are 50 is going to be disappointing. And that's why 50 looks the way it does. For the bears, it's a lower high major trend reversal. You can call it a head and shoulders top. We have a head on the 30 high. We have a left shoulder on 30, head on 37, right shoulder on bar 50. Low probability sell, 5-bar micro channel since the 46 low, but it's not a crazy swing short. Plenty of traders will sell below it. And then 51, 52, weak follow through, but 52 is a bad high one for the bulls, and that will increase the odds that we go a little bit lower. 53, outside down, but outside bars in a tight trading range typically lead to more trading range price action. And because of that, there's probably bulls buying below 52, scaling in lower. The bears, they really need to break below the 44 low and get follow through if they're going to get back down here. The other thing to point out is we've got 4,500, the big round number, not far below. Let's go ahead and add this really quick. So here is 4,500, big round number. We may have to get back there at some point today. 54, bad follow through for the bears, but a bad stop entry buy for the bulls. Some traders, they might have a stop above 53, and they may just have a stop 1 or 2 points above any bar. 55, weak stop entry buy above 55. Therefore, there might be more sellers above. And then you can see 56 is an inside bar. 57, bull bar, tight bear channel, increases the odds that buying above 57 will lead to a minor reversal. But you will have traders buying above it, hoping that we rally. In general, whenever you're buying above a bar, that is, I'm going to do right here. Here is the lower portion of today's range. And you can see we tested it on the 60 low. We're testing it again. We're above it on the 67 high. And whenever you have a lot of trading range price action on the open, it increases the odds that you're going to reach it. So that increases the odds that we're going to fall below 57 and that it will be a minor reversal. 58, bear bar closing on its low, possible bear breakout below a wedge. 1, 2, 3, 1, 2. And even though it's a higher low on 57, the bulls, they're hopeful that if we do fall below 57, we'll still form a wedge with 34, 46, and then maybe 61 or 60 somewhere down here. Follow through on 59. For me, if I'm a bull and I bought above this bar, I'm typically going to get out either below 57 or below a bear bar closing on its low. Here, with consecutive bear bars closing on its low, tight bear channel, I think it's not all that unreasonable for bears to sell below 59, taking a chance that we break to the downside. 60, weak bear bar, but another bear bar. So breaking below all the bars to the left. But what do you notice about 60? For me, had I sold below 59, I want the market to crash down pretty quickly. And if 60 closes like it does, I'm going to be really, really quick to get out because I know there's too much risk of a possible wedge, 33, 46, and 61, 62. And then 62, no surprise, big bull bar, but it's a pullback of the past 3 bear bars. Therefore, probably going to go more sideways. Tight bear channel. And for the bulls, if I'm going to buy above a bar like 61, I really want a bull bar closing on its high. And it'd be better for the bulls if they can start getting closes above the moving average. So maybe if the bulls can get 62 to be another strong bull bar, traders will buy. And instead, 62 triggered the buy above 61 and reverse down. What about buying below 61? Some traders might, but for me, this looks like this might be an endless pullback, and you have to wonder about the possibility of a downside breakout. 63, we tried to form a second entry buy and a double bottom with 60 or 61. The bears, they see the sell off down to the 60 low as a bear breakout, and they see the rally on 61 as a pullback, really up to the 62 high. And now they see the sell off on 63, the low of the bar, as the pullback attempt. They want a double bottom. So think about a major trend reversal on a smaller time frame. So if we go to 1440 on a 1-minute chart, we'll see it. Here we go. So we have this tight bear channel, micro double bottom, 1-minute chart. We rallied, so that's that stop entry buy, and then we had a sell off. And the bulls are trying to form a double bottom, but it became a minor reversal and led to a bear breakout. $64 bear bar closing on its low. What about buying the close of 64? I would not. This channel is getting pretty tight, and we have so much trading range price action earlier today. I would not be surprised one bit if we do get a measured move down. And the bulls just continue to fail, and the bears are starting to win with time. They're getting closes below the moving average. They're preventing the bulls from getting consecutive bull closes. So 57, 58 failed to close above 57, 62 failed to close above 61. All of that is a sign of strong selling, even though the selling is fairly tight. And then you can see 65, really big bear bar. For me, the problem with 65 is a huge bar, and it's forcing traders to risk a whole lot. And this situation happens pretty regularly where you get a leg in a trading range down to 63, 64, and then you get this plunge in the matter of one bar. And that forces traders to sell at support. So traders see it as a windfall of profit. They see a tight bear channel. They see a bear breakout below a bear flag. And what would you do? Let's say you sold the low of 64, and then in one bar you made 8 points. What are you going to do? You're probably going to take your profits. If you're a bear and you sold the low of 50 and you held short all through here, what are you going to do right here? In one bar, you've in essence doubled your profit. And it was already hard enough to hold short below all these bars and above all these bars. And because of that, this is probably more of an exhaustion bar than a start of a new breakout. Now, even though, I can make the argument that traders see that as a windfall of profit, I really like to see things from a logic standpoint. So in other words, my voice is a little bit congested, so I wanted to get a sip of water. So what do I mean by that? What I mean is it's really important to try and explain everything from a mathematical basis, not oh, well, the bears see that as an emotional bar, so they take profits, or, strong bulls, weak bulls. To me, the way I see it is this. The move, this behavior is already unsustainable, a lot of overlap. Then you get this big sell-off. It creates more of an unsustainable move, and that will cause traders to take profits. You have the trend line getting steeper and steeper and steeper. If you think about a 1 minute chart, it would be a very steep trend line. 66, bull bar, but a big tail above the bar, increases the odds that there's sellers above and that the bears that sold the 65 close will be able to avoid a loss. And that's what happened on 67. 66, though, is a strong enough bar that it really damages the case of a bear trend. So, more likely, there's going to be profit taking down here by the bears and bulls starting to buy. 68, second leg up. The bulls had a rally on 66 and then a pause on 67 and a second leg up 68. And because of that, you may have bears selling the close of 68 and the midpoint of 65, betting on a second leg down. And that's in part why 69 looks the way it does. 70, 69 was a high one buy. 70 tried to go above it, turned down. For the bears, what about selling below 69? I would not. It's a micro channel from 66 to 69 that lowers the probability of selling below the bar. Had 70 closed on its low, you may have had more traders selling. And even right here, we have consecutive bear bars 69, 70. The bears, you will have some traders buying below 70. Other traders, they may not buy below 70 because they're worried that the bears could get a downside breakout and there's an obvious target below the 65 close. You had bears sell the 65 close and they sold somewhere up here. They're probably disappointed and they'll buy back shorts at their original entry. 71, surprise bar, but near support. And when you look at it, it's a strong bar on 71, but the Bears really probably need a second leg. They need one more bar. And because of that, you have to assume that the Bears probably will not get one more bar. So there's probably buyers below 70 scaling in lower. And that's what happened on 72. 72, what about buying above the bar? I think it's okay swing buy above the bar. But this is one of those instances that happens all the time in trading ranges. Look at the very next bar. The market immediately went down. So in hindsight, 72 was a buy vacuum test of resistance. The 4,500 round number, the high of 71. You had bulls who bought the close of 70, scaling in lower. They were so disappointed, they got out at their original entry, and that created resistance. That's why a lot of traders, if they're entering on stop orders, rather than buying at the market on the close of 72, a lot of traders would rather buy on a stop above 72 because that way at least the bar triggered. 73, probably buyers below 72 or 71. And then 75 reversed up. So some bulls, they bought the 72 close. They buy more below 72. They get out break even around the midpoint. And then we pretty much went sideways to up around for the last couple of bars. For always in, always in is a really pretty difficult on a day like today. If you're buying above bars like one, it's really a difficult buy. For me, if you buy above one and then you see the weak follow through, some traders would get out. So they buy above 99.75. They see the bad follow through. They try and get out 99.75. And you can see the market allowed them to get out. But if you bought above one and you put a stop below one, your risk is pretty big. And a lot of traders would want 2 times the risk. And that puts you all the way up here. So the odds are you're probably not going all the way up here before it goes to the low of 1. So it's not really all that great of a buy. And for always in general, on the open, I like to see strong consecutive bull bars closing above their midpoints with one closing on their highs. So I think the bulls really need one more bar, and they didn't get it on bar 2. And then as far as always in, maybe buying above 6, micro double bottom 6 and 4, and then a bigger double bottom 1 and 4 or 1 and 6. I think that's an okay buy. Stop down here, but not ideal. And then maybe buying above bar 8, stop below, but not the greatest buy. Otherwise, traders just maybe they wait for a bull bar. and they can buy the close of 10, but it's still not really all that great. And then if you are long, you probably get out below 12. Aggressive bears might sell, but tight bull channel, so they don't. I don't think they have to. And then what do you do here? Do bulls buy? They probably can. And where do they get out? Probably below a bear bar, closing on its low. So we had one leg up, pull back, two legs up, bear bar. I think the bulls get out below that bar. And bears, do they sell? Some might. And if they do, they might exit a couple of points above 21 or just take a loss as the bar goes up. But I think 20 is a low probability sell. 22, probably back to always in long, top of the trading range. Better to wait for follow through. I think it's okay for always in bulls to start buying the close 22 or 23, knowing that they're probably going to be disappointed and have to be quick to get out. And in this case, the bulls get lucky. The market goes higher. Still always in long. Some bulls, they get out 1 or 2 points below any bar, and that would be during this bar. And bears, do they sell? I don't think they have to. If the bulls did get out, then maybe they buy again above 34 and they'd get out below 38 or below 41 right here. Aggressive bears might sell, but I think it's pretty tough to stay short above a bar like this. And when the market starts going down like this, forming a wedge with bad follow through, you have a lot of bears who will start scalping out of their position rather than waiting for this bar to form. And then some traders might buy above and they get out below this bar. Bears sell. And where do they get out? They probably get out above 57. But then what do they do below 58 or 59? They probably sell again. And then they have to get out above this bar. And then this gets really tricky. If you get out here, you sell again here. Some traders might, others might sell 64. But you see where I'm getting at. There's so much back and forth. It's really, really easy to get chewed up with days like today, trading stop orders. So most traders should be very careful. Limit orders, lots of limit order trading. Bulls buying below 1, buying below 2, bulls selling above 4, scaling in, selling at the break at the mid at the 2 low where bulls got trapped, buying below 7, selling above 6, buying below 11, selling above 10, buying below 13, buying below 16, selling above 17, selling above 16, even selling above 14. And you could argue even buying below 18, 17, or even the bear bar here. And bulls, I think bears probably selling above. Bulls, I'd rather sell closer to the moving average. And let's see here, probably buyers below 45, sellers above 48 or 49, but pretty tough. And then this gets really challenging. But obviously sellers above bars, probably buyers below 70, scaling in. And that's probably it. For buy the close, sell the close, I thought it was buy the close, maybe 23, 24. But then when you see 25, that's more of a profit taking bar and not an ideal buy the close bar. But it's really common when you get an exhaustion bar or a climactic bar like 25, 50 to 60% of the time, you typically get a small second leg, and that was 27. And I don't think it was buy the close, sell the close anywhere in here. And maybe not for the rest of the day. Maybe if you sell the close of 65, I think that's pretty dangerous. You're selling at resistance. Most traders should not do that. You're selling at support, and most traders should not do that. Let me take a look at questions. Okay, question. I sold bar 50 right here. I thought that was good. Looking for a major trend reversal, but got out above 57 here. Is it ever okay to stay in after 57? I considered selling below 58 here or 59, but just felt like I was selling at the bottom of a tight trading range. Do I have to sell again? That is a great example of what I was trying to explain through here. I'm always thinking about how easy is it to sell. I took the sell below 50. And for me, I can't remember what I did. I sold. I ended up getting out somewhere in here. I think I got out maybe during this bar. I made a small profit, sold, and then I think I got out somewhere in here. And anyways, I ended up buying above 57, taking a chance we'd rally. I was too slow to get out, so I got stopped out below the bar, and then I went short below 59, but I got shaken out on 60. And I think, maybe I made 1.3 ticks. I can't remember. But 60 broke down and then pulled back pretty quick. And my concern was what I pointed out, a wedge 34, 46, and 60. But the point with that is it's never all that clear. The one thing I don't want to do is I'm happy to take chances, sell below 50, hope we crash, buy above 57, hope that we rally, and sell below 59, hope we sell off. But eventually, it becomes more and more difficult. And that's in part why this happens. You have a lot of traders trapped out, and then you start to get the breakout, and everyone's selling as it's going down, but then they buy back shorts. Compare that to Friday. Who's buying here? There's really no one buying. Obviously, traders are selling, and therefore the market is obviously going to go lower. First reversal up is probably going to fail. So for me, I think what you did is wise. You get out below 50 and you got out above 57. I think that's okay. 57 is a low probability buy above the bar, but it's still a double bottom in a trading range. And who knows? 58 could have been a strong bull bar. And as far as selling below 57, you can keep it pretty simple. You sell below 57. As far as selling below 58, you can keep it simple. You sell below 58, stop above. Bull bar or bear bar, maybe you move your stop, 1 point above this bar or keep it above here. Another bar, maybe you move your stop above your entry bar. And then you see this bar and you think wedge, maybe you get out 1 point above the bar, 6 ticks above the bar, and you can see what happened. It triggered the buy and immediately turned down. And arguably, that happened the whole way down. Even here, 57, the bulls were unable to make a 1 point scalp. Their entry price would be 9 even. They needed the market to go to 10.25 to get filled, and it went to 10 even. So a lot of traders had to stop 6 ticks above this bar, trying to prevent the bulls from making a 1 point scalp. Okay, question. I've been following you for some time, and I observed you mostly follow micro channels. I want to know if I'm right that you mostly won't allow price to fall below the previous bar. No, it's not really true. Micro channels are just a breakout on a higher time frame. Every breakout is a micro channel, but that's all in the course. Do you listen to music when you're trading? Yeah, sometimes do. Sometimes I listen to music, and it really varies. It's when the market immediately opens, I'm much more focused on what it's doing. If you know, if I'm buying, let's say, usually if I'm taking a swing trade, I might be a little bit more hands off. So if I'm selling below this bar, like 50, and my stop's above 50, there's only so many choices. I might sell, take part off down here, and then set another target down here. And that's just a reach target. I'm hoping that we just get a plunge down. In other words, I'm hoping that this happens. We just plunge. I know it's not going to happen. I suspect it won't happen, and I suspect to be disappointed. So if I'm swing trading, I might sell, stop above, and it's kind of like watching paint dry. You're just waiting for the you're waiting to move your stop. You get a doji, and then you get an outside down bar. I'll move my stop up here. But it really depends. If I'm scalping a lot with limit orders and I'm making a lot of decisions quickly, obviously I'm a lot more focused on what I'm doing. Okay, question. In the first 2 hours, there was disappointing follow through after every buy signal bar. Is it better to hold long in situations or get out after disappointment and wait for the breakout like bar 22? For me, when I'm disappointed, I like to get out. So I don't want to take a lot of losses. And For me, this is relatively difficult stop order trading because it's great limit order trading. So for me, if I bought above 8, which, for me, if I bought above 8 and my stop's below 8 and then I see 9, I might scalp out. Rather than exiting the trade on the 9 close, I might set a limit order halfway up the bar of 9 or maybe in the upper third of the bar because 9 is a trading range bar and start selling here. And then once we start to go sideways more, exit the full position. But for me, whenever I'm disappointed with the stop entry, there it's never a bad thing to exit the trade. Look what happened below 20. You had bears selling below this bar right here, 20. And then 21 is a weak bull bar. So what do you think those bears are doing? Those bears saw 21 as a weak entry bar and they started buying back their shorts. Okay, question. To identify the market cycle. Okay. So question about market cycles. And in order to apply a trade for a trading range, do you look at the 20 bars or 50 bars or 100 bars to the left? Do you check higher time frames? For me, it varies. I look at the context. So for me, I see all this. I know we're in a trading range. I know on the open that there's an 80% chance at a minimum we're going to get an opening swing. I know typically before the end of the second hour, you're going to start the swing and already had a bullish bias going into today. We had a big bear bar on the daily chart. I thought today would be a weak bear bar or a bull bar, but I did not think the bears would get strong selling pressure on the open. Plus, look at bar one. Bar one's a big bull bar, and then bar two is a big bear bar. Excuse me, bar three is a big bear bar, and that's a warning that we may have a lot of trading range price action. And as far as higher time frames, I'll sometimes flip to higher time frames, but for the most part, I'm just trading the chart in front of me. I took trades in crude oil for today, for example. And if I'm trading crude oil, I'm just watching the chart. So here's crude oil and trying to remember what I did. I think I started selling up here and I stayed short because for a few reasons. One, we're in kind of this broad channel. Man, I saw this more as breaking out above the channel. And then number two, leg one, leg two, leg three. I thought at a minimum, there's probably going to be more sellers up here than buyers. When this bar formed, I don't remember if I sold more but I know I put my stop up here. And then at some point, I think I tightened my stop to here. I got, I got a little bit, I made a mistake here. I got shaken out of the trade, ended up closing my position here, but for a small profit. And then in hindsight, I should have held. And I think I bought a pullback of this bull bar for a second leg, betting we would close this breakout point. It's easier to see on a 5-minute chart. So you can see it right here. We're in a channel. We broke far below. We got a second leg. I thought this breakout was strong enough for a second leg. And if I'm a bull and I bought the close at 1350 right here, I'm disappointed by these three bear bars, but I'm betting it's a trading range. Look at the retest. Big bull bar, another big bull bar. Does that look like there's a lot of traders selling out of longs? Not necessarily. This bar bounced up and down a lot, but when it closed on its high, more traders started buying. You don't have to look at several time frames to understand that. So sometimes I'll typically glance at a 15-minute chart just to get an overview of the day. But for the most part, I'm just trading the chart in front of me. Was it reasonable to buy below 63 right here? You could, but it's a tight bear channel and we have possible negative gaps. So for me, if I'm buying below 63 and then I get a bear bar like 64, I'm exiting the trade because there's just too much risk of a downside breakout. reading through more questions. Do you think about an impactful trade in your trading journey? There's a lot of impactful trades. For me, it's more of the, I guess, dumb trades. And there's a lot of really dumb trades. For example, there's been numerous days, I can't tell you how many days I've bought and scaled in lower, sideways, scaled in lower, and you just get absolutely killed. So at some point, you just start to learn that that's a really bad strategy. So if you're buying and you're scaling in and then you see a big bar like 17, you should get out. But if you see another follow through bar like 18, you just have to get out. So if you buy anywhere in here, big bear bar follow through, I've got to get out. And then there's other examples of buying in tight trading ranges, buying above bars in tight trading ranges, selling below bars in tight trading ranges. And eventually, you just learn not to do that. Another one is, trading the first bar. Now, if I ever, in cases like this, I did buy above one, I ended up buying more below one, but typically I'm always expecting something disappointing with bar one, because 20% of the time you get a bull trend from the open. 80% of the time, if not more, bar one is not the high or the low of the day. But your question, really what it comes down to is experience. The longer you trade, the more mistakes you make. So I look at mistakes more or less as opportunities to learn. And there's several mistakes you'll make, but the more you study and the more experience you have, the less mistakes you'll make down the road. Okay, question. I bought above 15 right here. I think that's an okay swing buy, but flattened out on 16 because it was disappointing. Should I hold until I see the bear bar, or is it okay to get out quickly? Again, I think it's always okay to get out quickly. Part of the reason why we went sideways is because 16 was a bad entry bar. All right, so that's it for questions. Tomorrow, it'll be interesting to see. We have a bad buy signal. We have a bad stop entry buy above today, and we still may get a second leg down here. All right, let me see here. So here's the opposite example. We have consecutive sell climaxes on the euro dollar. If you read the blogs, I talk about the euro dollar just about every day. Big bear bar, possible exhaustion at support, the May 31st low, and we had a bad stop entry right here. But look right here, we have strong follow through. And because of that, I think there's an increased risk that the market is here. I think it's an okay swing buy. Now, I want to preface that. It's an okay, I want to be clear, it's an okay swing buy, taking a chance that we rally. It's still a low probability buy, and the chances are, if you buy here, you're going to be disappointed. But the reason I'm bringing it up is this. Here, the context is a little bit different. The other one, in the euro dollar, we had a broad bear channel. Here, if we get a bull bar closing on its high right here, it's still a tight trading range, and there could be sellers above. So I think we're going to be sideways. I suspect there's sellers above, and the bears will try for a second leg down. But I wouldn't be surprised at all if if the bulls get another bull bar tomorrow. All right. Okay. This is a good question, so I'll talk about it. Can you talk about having a bias in the morning based on the daily chart? Well, if you go back to Al and remember one thing Al always says, price is truth. What that means is you can never be in denial about the price action. So it doesn't matter. I can have any premise I want about the daily chart. Let's say today. Today, I thought we would have an early low of the day, or I thought we would form a bull bar on the daily chart. So if this is today, and I start to see 3 bear bars, 4 bear bars, we try to bottom, and then we see a plunge on 17 and 18, can I still say, oh yeah, it's going to be a bull trend day, even though the open of the day is all the way up here? Of course not. So if that's ever happening, you have to look at the chart in front of you. So for me, my number one price is always your truth. It is what is in front of you. So for me, if I think we're going to get an early low of the day and we keep getting bull bars and we're going sideways, yeah, that's in line with the daily chart. But if we're starting to get strong bear trend bars, then that's a different story. It's just like right here. We have a big bear bar. I think we're going to try and close above yesterday's high. But if we have a big bear bar here and then another big bear bar here, that could be that would be totally different context. All right. Thanks everybody for listening, and I will talk to everybody soon.